Hello and welcome to FedTax 101. In Episode 1, we discussed the requirement to clearly reflect your income by matching as closely as possible a dollar of gross receipts with the cost that you incur to earn that dollar. In Episode 2, we discussed the receipts that are income for federal tax purposes. Today, we're going to discuss the other half of the matching equation, the costs that produce your business income and how we match up that cost with the related items of income. To give you a sense of where we're heading, we're going to divide a business's costs into three broad categories: capital assets, ordinary operating expenses, and inventory, and discuss how the matching concept applies to each. We'll go into each of these topics in more depth in later episodes, but today we just want to introduce the broad concept of cost recovery. To get started, let's discuss one of the Supreme Court's most important cases in this area because it establishes a useful framework for our discussion. The year is 1974. Idaho Power, an electric utility in the state of Idaho, builds and maintains the various things an electric utility uses in running its business, including its network of power lines. The company owns a fleet of various types of vehicles, including construction equipment used in building new power lines. The Supreme Court was asked to consider how to treat depreciation on the equipment that the company used during the year in building those new power lines. The taxpayer argued that the tax code says you're allowed an annual depreciation deduction on specific capital assets that you use in a trade or business, including vehicles. Since it was using the construction equipment in a trade or business, the literal language of the tax code allowed it to deduct all of the annual depreciation on that equipment, regardless of how it was being used. The IRS disagreed. It said that while the tax code does permit an annual depreciation deduction, the code is equally clear that you cannot deduct anything you spend to acquire a capital asset. Because the new asset will generate revenue over multiple years, all of the cost of acquiring that new asset have to be matched up against that future income as well. The Supreme Court agreed with the IRS. The court said it isn't enough to say that the tax code allows you to deduct depreciation. Instead, you have to think of depreciation as a cost. The wear and tear you put on your property is just as much a cost to you as is using cash to achieve the same end. You can pay someone else to do something for you and have them include the wear and tear on their equipment in the price you have to pay for the goods or services, or you can wear out or consume your own property to take care of it yourself. So essentially, you can pay that cost either in cash or in property. The end result to you is the same. So depreciation, the consumption or exhaustion of your own tangible property, has to be treated like any other cost that you incur in running your business. In deciding how to treat the depreciation on your equipment, the question becomes, what did you get in return for that cost? If you use the asset in the routine course of running your business, just day-to-day operations, then you can deduct the depreciation this year just as you can any other routine business expense. For example, if you hire a cleaning service for your offices, their cleaning fee generally is deductible this year. If instead you buy your own cleaning equipment and do it yourself, you can deduct the annual depreciation on that cleaning equipment as well. The assumption is that in both situations, the cost of cleaning your offices is not going to produce future income that you need to match up against that current year cost, regardless of whether you pay it in cash or in property. On the other hand, the taxpayer in Idaho Power was doing more than that. It wasn't using its construction equipment just in running its day-to-day business. Instead, the Supreme Court said the company consumed or spent a portion of its investment in its existing equipment to build the new power lines, which themselves are an asset that will produce revenue for many years. So the cost the company incurred in wearing out its construction equipment to build the new power lines was part of the purchase price of a new asset. And as with any cost of a new asset, that cost has to be matched up against the future income from that new asset and recovered over time rather than entirely in the year of the purchase. So when you buy tangible property that wears out over time, it isn't enough to say you get to recover that investment through annual depreciation. Instead, you have to think of the annual wear and tear on the equipment as a cost of running your business, the consumption of a portion of your original investment, and analyze it the way you would any other business expense. Does it relate only to this year's income? Or do I need to match this year's depreciation cost against future income? This would be true regardless of how much depreciation you might otherwise be entitled to deduct for a given year on any particular asset, including so called bonus depreciation. Some assets don't wear out over time, though. For example, land. If something doesn't wear out as you use it, then under the reasoning of Idaho Power, you aren't really incurring a cost in using that asset in your business. Because you don't have a cost, the tax code does not allow you to deduct any depreciation on that asset, ever. Instead, for things like land that don't wear out, the tax code makes you wait to recover your investment until you sell it by subtracting the original purchase price from the sales price and computing your taxable gain on that sale. We've already talked a little bit about the second major category of business costs, the routine, day to day expenses of running your business. In tax lingo, your ordinary and necessary business expenses, your utilities, rent, employee wages, advertising, routine repair and maintenance, office supplies. The scope here is pretty broad. The Supreme Court has said that an expense is ordinary if it's common and accepted within the taxpayer's industry, even if the taxpayer itself might only incur that particular type of expense only once. Something is necessary if it's appropriate and helpful. That sweeps in almost everything your business spends that isn't for some sort of asset or for inventory, subject to certain statutory limitations on various deductions, things like fines, penalties, lobbying expenses, the costs of entertaining clients, and various other things. The tax code also permits deductions for certain other very specific costs, such as interest, business losses, the costs of starting a new business, deductions for specific types of investments or activities that Congress wants to encourage through tax deductions, as well as various other very specific things. For purposes of today's high level introduction, though, let's just include all of these under the general category of current expenses. The final major category of business costs that we want to introduce in this episode are the costs that you incur to acquire goods for sale to your customers, your inventory costs. Here again, we can't just deduct the cost of our inventory, our cost of goods sold, or COGS, as we buy it. Instead, we need to try to match up the total cost of particular types of goods with whatever we eventually sell those goods for. That way, we can clearly reflect how much income we make from selling that particular type of merchandise in a given year. Some types of inventory won't sit on the shelves for very long. Groceries, for example. Some types can sit there for a long time. So, in order to match what it cost us to acquire a particular type of inventory with what we earn from sales of that product in a given year, we can only deduct our COGS as we sell that particular type of merchandise. That might be this year, it might be next year, or sometimes even later. But we'll use an inventory method of accounting, such as LIFO, FIFO, and some others, that makes that match for us in whichever turns out to be the right year for the sales of those goods. This is true regardless of whether we resell things we buy from someone else or whether we manufacture the goods ourselves. This goes back to the Supreme Court's second line of reasoning in Idaho Power. It emphasized the need for parity between resellers and producers in coming up with the total costs of acquiring something. So, back to our Idaho Power discussion. There are quite a few costs that you normally would just deduct as ordinary operating expenses: wages, utilities, routine repair costs. But if those otherwise deductible expenses relate to the manufacture of your inventory, wages paid to your production staff, the electricity used by the manufacturing equipment, or repairs to that equipment, you have to treat them as a cost of the merchandise you're producing. That puts you on a level playing field with someone who buys the merchandise ready made, with the manufacturer's indirect costs and overhead already built into the wholesale price the retailer has to pay. As an aside, cost of goods sold is a concept that only applies if you're selling tangible property, goods. You don't have cost of goods sold if you're a service provider. Most of the time, all of the cost you incur to provide a service to your customer, whether you're a construction company, a medical provider, a law firm, etc., are going to be ordinary operating expenses like labor, supplies, and overhead unrelated to the production or resale of merchandise. So, to summarize, the primary lesson from today comes from the Supreme Court's decision in Idaho Power. For each of three primary types of business costs: capital assets, ordinary expenses, costs of goods sold, what matters the most is what you receive in exchange for a given cost, regardless of whether the general rule normally would let you deduct that cost on this year's return. Sometimes, even the most routine costs can become part of the acquisition price of a new asset or cost of the merchandise on your store shelves. Following the basic lesson of Idaho Power will help you figure out the specific rules you need to start exploring to fully unravel the correct tax treatment of a given cost in order to ensure a proper match between that cost and related revenue. Well, that's it for this episode of FedTax 101. Keep checking back for more.